I'm Deborah Trowell of Elevation Financial Group. This is the Elevation Market Update, where we help you make more sense of what's going on in the economy and with investing. Today I have Brett Boyd of Delaware Macquarie in conversation with me this morning. He's talked to us before, and Brett has worked with Delaware Macquarie for 12 years now. I'm based in Dallas, Texas. So Brett, welcome.
Thanks, Deborah. It's great to be here.
So we are now almost in the middle of 2023, and really the nation has just been gripped by the whole debt ceiling conversation going on, worrying about whether it would be increased or not. So could you start out by telling us what the debt ceiling is and what's been happening?
Absolutely, Deborah. Sure. Yeah. So the debt ceiling really is the total amount of debt government can have. And that is referred to as the debt ceiling. And currently we are at 31 trillion with a T, trillion dollars of debt. Just to put it in perspective, it took 227 years to get to $8 trillion. And we've spent another $8 trillion just in the last 3 years. Another fact, by 2033, that we'll have 25% will just be spent on interest alone. So we need to do something as it relates to getting a hold of this debt problem. What they did this last week with the debt ceiling is they didn't raise it, they just suspended it. And they gave the Treasury pretty much free rein on what they could spend over the next 2 years into 2025. So hopefully they don't spend more and more and more, but they probably will a little bit. Eventually, I'd say in the next 5 to 10 years, it needs to be addressed. But for right now in 2023, we avoided a debt ceiling crisis. It has been passed, and the market responded very positively for that news on Friday.
Yes, and interestingly, if we take away all this talk about the debt ceiling, the market so far this year has had some nice positive returns. So what else is going on that's making that happen? Yeah,
so it's been great in the sense that the Nasdaq's up 26% year to date. The S&P year to date is up around 11%. If it was an equal weighted S&P, we'd be flat. So what that means is there's really 8 stocks that's really carrying a lot of this market for the year. And those are what's called the FANG stocks, the Facebook, which is now called Meta, Alphabet, Netflix, Google, and then Amazon, and then also NVIDIA and Tesla. And so the rise of this new craze of AI has really gripped these type of companies, and specifically NVIDIA with the GPU chips. I won't get too far into it, but they're up over 160% year to date. And a lot of these other AI type of stocks around them have done well. And so we'd like to see all the other companies in the staples area and the cyclicals area, healthcare, financials kind of catch up. But so far it's been a market where 7 stocks have really carried it. And although last Friday was a really nice day for all the cyclicals as well because of the jobs report.
Yeah, and when you talk about the Nasdaq, that's the index for the tech stocks, right?
Mm-hmm. Yes.
Yeah. Yeah. So I do want to interject, as you mentioned, some of these companies, talking about NVIDIA doing so well here, and that we're hoping that companies like Microsoft and Google come up on behind it. Of course, nobody in this presentation is recommending that anybody run out and go buy those stocks. If you have your diversified portfolio, you will actually probably have these in your portfolio already, ready to do some work for you. All right, so Brett, besides technology then, which is easy to get excited about and has been an area of great growth, what other areas is Delaware Macquarie finding opportunities?
Great question, Deborah. Yeah, we like the opportunities currently in the mid-cap growth and income space. The valuations for those companies are still quite low, and there's a lot of opportunity there. It has an income component as well. the Delaware Ivy mid-cap growth, for example, with the income component. We also are finding a lot of opportunities in the muni space, the municipal bond and municipal mutual fund space. A lot of the municipals have really had their cash flows given to them over the last 4 or 5 years by the government. The default risk is very low, and you get some good tax-free income in those areas, and the bonds are very cheap. So we really like the areas of municipal bonds as well.
And those, of course, are the types of bonds we would be using when we build a portfolio that we want to be tax efficient and help to manage the client's tax bill. I think I have one other question in here. When you talk about mid-cap, what does that actually mean?
So you have small cap, and we're talking about cap as in capitalization of companies. You know, the large cap companies are well over, I would say, 13 billion and up. The small cap companies are around 2 billion and lower. So the mid cap or the mid capitalization companies are companies that have a capitalization worth around in between 2 billion and 12 billion is the definition for that.
And mid caps, I think, have been a great portfolio builder. They're not quite as volatile as small companies getting started, and they do have an income component, right? Like larger companies, so they can be a good thing to add in to breadth of the portfolio being built.
Absolutely, totally
together.
agree there.
Yeah. So we're looking at all the positive things here, but what else is Delaware Macquarie keeping their eyes on as factors to consider as you decide what companies to have in your funds?
Well, we're looking at, you know, current macro conditions. You know, we like looking at the inflation mark there. You know, we like looking at the type of areas right now that are kind of alarming as far as inflation, because it's above 4% right now, and so we want to see what the government does there as far as getting that down. Consumer strength is very good. There's a lot of cash in the market there. Employment is very strong still, and the recession is really not, in our opinion, expected until next year. So the type of things we look at in the companies from looking at that macro backdrop are just quality companies that have good cash flow, strong balance sheet, and they don't have to borrow a lot.
And that's key for everybody, isn't it? Whether it's an individual or a company, not having to borrow money in which to help do business makes for a stronger company.
That's right.
Yeah. Yeah, and inflation and 4% actually sounds quite good after we've had, you know, a year ago was 9.5. The Fed, with its aggressive stance, has actually done quite well at bringing it down to this level, hasn't it?
It has. It has. We have a little bit ways to go, but you're right, Deborah. We've come a long way since over 9% inflation, and now we're just a little bit above 4%. Hopefully, we can keep the trend coming down. If that's the case, then we think the recession could be very mild. We don't think a recession is really going to happen, you know, for a while, just because there's still a lot of cash flow out there, both in corporations and for your clients. So we don't think there's going to be a recession right around the corner. We think it's going to take a little while, and that's going to bode well for your clients' portfolios in the markets in general.
Yes, I think the jobs numbers are the big thing, right? As those interest rates were being increased, I think there was a lot of worry about whether companies would really cut back on their hiring.
Yeah, and so basically, with what the job numbers came in really well on Friday. You know, it was the consensus was supposed to be about 180,000, and instead it was 339,000. And the jobs were added across multiple sectors, government sectors, business and professional sectors, everywhere. And you've seen a pattern there of more jobs coming in. But also, it was a great scenario because the average hourly earnings rates went down. And so what that shows is a lot of people that were on the sidelines that weren't looking for work have now come back into the workforce. And so filling up the jobs that are there. And so you've got more jobs there with more people in the workforce. It actually increase the unemployment rate. It's exactly what the Fed wants as far as that, and lower the average hourly earnings rate as well. So that's a really nice scenario. Hopefully it can continue.
Yeah, and obviously there's always things to be worried about in the economy. There will be our new talking points coming up shortly now that we have the debt ceiling out of the way. But overall, what do you think investors should be keeping in mind as they try to figure out their path through the investing world?
Sure, I would just stay defensive at this point. Stay the course. Don't make any drastic moves in the portfolio. This isn't the time really to take a whole lot of risk.
Yeah, and we always talk about that. Stay diversified. Don't buy too much of any one thing, or start evicting anything from your portfolio just because right now it doesn't seem to be doing the best in performance. So thank you, Brett. This has been some great information this morning.
Thanks for having me today. I appreciate it.
Okay. Yeah, so we look forward to talking with you again another time. For our listeners, that's what we have today for our presentation, and hope that you found this helpful. Of course, if you have questions about your own portfolio, we are always available to answer those. Just shoot us an email, give us a call at the office. And we look forward to having our next update in August, I think. We'll be sending out the recording on today as soon as we're able to. Thank you. Have a great day.